Most of the time when we think of a dividend, we think of the firm returning the profits of the firm to the shareholders. Right? The firm has made some money and now it's saying, hey, we're going to have a dividend. We're going to pay out some of these profits back to our owners. However, there are cases where a dividend will be paid not out of profits, but actually out of basically a return of the shareholder's initial investment, out of paid-in capital. And this is what's called a liquidating dividend. So assume that a firm said, okay, we're going to have a dividend of $500,000. But you took a look at the retained earnings, which is basically the profits that the firm has chosen to keep over time that have built up in the firm. You look and you say, well, we only have retained earnings of $200,000. Right? So does that mean we can't issue a dividend? Of course not. If the firm has capital and there's no kind of lending agreement or anything restricting an issue of a dividend, the firm can issue a dividend. So where does that come out of? Well, what else do we have in equity? Well, we have an account called APIC, additional paid-in capital, right? When we raise money through a stock issuance, this is where this comes from, right? And this is often a very large amount. So basically, we just say, okay, let's just make our entry. So we've got retained earnings is going to be the first thing to go, right? The dividends are first going to be paid out of that retained earnings balance. So the first $200,000 of the dividend comes out of retained earnings. Now retained earnings is at zero. Now what do we debit? We debit additional paid-in capital for $300,000. Okay. And then in terms of crediting, we can just credit dividends payable, so we probably didn't pay the cash the same day that we declared the dividend. So we'll just have dividend payable for $500,000. And of course, when we actually pay out the dividend, we'd have a debit to dividend payable to get rid of that account. It's $500,000, and then we'd credit the cash for $500,000, just like a regular dividend. But the main idea here is this: a firm can pay out dividends. In many cases, even if that dividends would bring the retained earnings to zero, and so then we start drawing the money out of additional paid-in capital. Now, in some cases, this is just kind of seen as, okay, well, we're returning some of the shareholders' investment to them, to their capital to them. In other cases, it might be that, hey, basically the firm is going under, right? We are actually ceasing operations, and so we're just liquidating everything we have, and we're just paying it all out to the shareholders. Now, a lot of times shareholders end up losing their shirt when this happens, and there's really not much of anything that's going to them. Money's going to lenders and so forth. But if the firm's in decent financial condition, they'll just pay out everything out of retained earnings, and when that's done, you start paying out of additional paid-in capital.